Hi, it's Aoife and Devitt, and welcome to today's Markets Happy Hour podcast. It is Thursday, September 18th. I'm sitting here in London, and we've just had the visit from President Trump and First Lady Melania Trump to Windsor Castle. So a lot of pomp and ceremony and some fanfare, and quite interesting news regarding the UK economy as well as the US economy. So some real convergence this week. So let's kick off. As usual, I'm sharing the slides here, and I've called today's podcast, along with the picture of Windsor Castle, which I was actually at, although not at the same meeting that President Trump was at. I've called it a stitch in time, as there has been a preemptive cut by the US Fed this week, 25 basis point cut, not the double cut or the jumbo cut that had been expected. And could this be that this is a risk-based approach? It is designed to avert any chaos in the economy and any potential slowdown. So it is a stitch in time that would save nine. And although we know that certain commentators certainly would wish for a lot more than that. And then on the other hand, other central banks similarly are not taking this action. The ECB paused last week. The Bank of England paused this week. So they are not taking that stitch in time at this stage. So let's see what that means in terms of their economy and the divergent outlooks. As usual, the regular topics will be inflation, interest rates, geopolitics, equity markets, and other. We'll take a look at not only the US dollar and its trajectory, but we're also going to look at some stress tests that some commentators have regarded, according to a survey taken by Bank of America, as the most likely downside scenarios. So we're going to take a look at some of those downside scenarios and see what it might mean for your portfolio. It has been decision time on inflation and jobs. The US Fed has had to decide between which of its twin mandates it is going to give priority to. We know at this point it seems to have selected jobs. We'll go into that in a little bit more detail. We ask if 25 basis points is now no longer enough, because markets have actually been discounting that in and expecting something a lot more and needing, in fact, becoming almost hooked on the idea of having a larger rate cut. We're going to talk about equity markets, which have been generally continued to be mired in noise this week, and some interesting pockets of strength, particularly in China. And then we will look at those 5 stress tests and see whether the portfolios that you have are appropriately set up given what could be a downside scenario. When it comes to inflation, the word is stubborn. Inflation is remaining stubbornly above the Fed's 2% target. But based on the decision by the Fed, it seems that that is no longer a real target for them. They are prepared to look through that, maybe to see some of the transmission effects as being a bit more long dated. And they are looking instead at their similar objective of keeping unemployment low. And on that basis, the recent weakness in jobs numbers and the revision on a backdated basis of jobs numbers seems to have given them confidence that they can now take this action, although it was mired in quite a bit of risk-averse and cautious language. But we can see here that year-on-year change remains above the target and is probably heading a little bit north from there instead of south. If we compare this to the picture around the world, we see quite a divergent set of numbers. Overall, the UK is standing out as an economy that has a persistently higher rate of inflation than seems tolerable by the general consumers. 3.8% has been repeated again as August. That's a steady hold from the rate in July. And we also have heard that because of food prices in particular being high in the UK and service prices staying stubbornly high, there is an expectation that the rate will now move towards 4%. So well above any target in place. The Bank of England has chosen to pause its rate cutting cycle. It has cut rates 5 times over the course of the past year, the 12-month period. But they are now pausing because they've seen that there simply is too much downside risk of reducing rates at this stage. And we've also seen the Chancellor in the UK comment that she feels the pain of the consumer, that she knows that the consumer is struggling with these kind of month-on-month increases in inflation, particularly when it comes to staples like food. So we do expect this, combined with the fact that there has been quite a low growth rate in the UK. The growth rate has been around 0.3% for the last quarter. That is clearly that cocktail that would lead to a gentle stagflation, if not a full-blown stagflationary scenario. So definitely quite a divergence from the US position on inflation there. And then just to look at Europe, again, dramatic divergence in Europe. Just to take two countries in Europe, Spain, Germany and France. In France, we have inflation at 0.8% annualized. In Germany, closer to the European average of 2%. So clearly well at that level that the ECB could be comfortable providing some stimulus to the economy in that juncture, but quite a divergent global picture still. The rhetoric used by the US Fed in making this its first rate cut, it's since December. The first rate cut, it has now been said that it was basically a meeting by meeting approach. They realized that there was no risk-free path available. They also suggested that they would have to take this risk-based measure and that this was essentially a risk management cut. So it's a stitch in time that they're taking to avert any further pain in the economy. We can see that when it came to it, the markets had actually interpreted this because of their expectations, perhaps getting a little lofty. The markets had interpreted this as a hawkish move by the Fed, not to cut by more. There was a lot of analysis as to the breakdown and the fact that only one Fed governor, the newly appointed Steve Moran, he had voted for a double cut, that he had not been with the majority, but that interestingly, the rest of the Fed governors had very much been lined up behind a single cut, despite the fact that they were Trump appointees in some cases. So clearly there was a desire to remain independent, not to do the bidding necessarily of the president, and that instantly then sent into disarray the bidding statistics around who would be the next Fed chair, because it had been expected that some of those nominees would be in pole position to take on the chair position. But now it seems that because of them not necessarily getting into line, still voting for a cut, but not a jumbo one, that may now throw open the playing field for the Fed chair appointee. So that did throw the betting markets into some disarray. But in terms of just what was the market reaction to this so-called hawkish move, you can see that the S&P initially fell and then rose and then was softer again. The dollar fell, rose briefly, as there wasn't clearly the same set of cuts, which would normally be weak for a dollar. The 2-year bond yield dipped and rose, and similar to the 10-year bond yield. So it's clearly an expectation that the Fed is not going to be a pushover necessarily when it comes to rates. And then this is the part of the podcast where we also speak about the vibe check and take just a check-in in terms of what's happening in the markets, particularly in the US, given that is the main equity market that we cover. And there is a sense that there is a disconnect and this cognitive dissonance between some of the numbers and some of the reality on the ground. And we know already that even the numbers themselves are somewhat fragile, that they have been revised downwards in the past, and now we've seen these numbers being enough to tip the Fed into a decision around the interest rates, but also suggesting that the job market is worse than it looks. And if we look behind the scenes, that there are perhaps a longer time spent, particularly by graduates, looking for work. We do know that many of the corporate numbers that have been so positive on the equity market have come about because of significant margin expansion projections due to cost cutting on the employment side. And we also know that just anecdotally, the replacement effect of AI is likely to only gain more and more traction. So this sort of nagging issue around the job market being quite soft. And I've got some more soft indicators later when we speak about sentiment around the market being overvalued and some of the concern around a potential crash, what it would be that would cause that. Another interesting narrative that has been emerging from some fixed income analysts is around the suggestion that there is kind of a game of two cities, or essentially a situation of two cities when it comes to fixed income. We know that bond yields have been quite volatile on the fixed income side. There has been a sell-off of the longer dated government bonds. Some of that has been due to a concern around the fiscal position. Some of that has been contagion effect of those sell-offs around the world. But we know that generally government bonds have been more volatile and given some concern because of the rise in yields. On the other hand, we have corporate credit being stronger than ever, with spreads on corporate credit at historic tights, particularly for this stage of the economic cycle. So that is, while it is good news for corporate bond holders, and the sense that the default rate probability is very low, and that generally the credit quality is perceived as high. This is not such good news for active managers seeking an entry point to buy into fixed income at this stage. They would generally consider the fixed income does not present good value, does not look like a great opportunity set. So, but it is interesting to see just this divergence in the perception of credit quality across the spectrum, ranging from corporates to governments. So whereas the traditional risk-free assessment was generally attached to a government, we now are, interestingly and ironically, less confident in the government and more confident in corporates and their ability to rein in their expenditure, perhaps because corporates are accountable. I would suggest that we've seen corporates after '08, after those crises, and particularly on the equity side of their balance sheet, we see that corporates are forced into scrutiny at this point every quarter. We know that after '08, they were forced to be publicly accountable for their finances, for their credit worthiness, and perhaps that accountability has kept them in line and led to more investor confidence. While on the government side, and there is less investor confidence, perhaps less accountability, and less ability for there to be necessarily an end game to this spiral that we're seeing in terms of fiscal deficits. Again, the Fed is not the only one who is perceiving a risk-fraught environment and is concerned. On the Bank of America Fund Manager Survey, a record net 58% of the investors view the global equity markets as overvalued. Much of that, no doubt, stems from the position in the US, where we have seen that 40%, as I mentioned, in the top 10 stocks, quite record highs being hit. And all of this against a backdrop where we would have earlier in the year been expecting a much softer economy. So a surprisingly resilient economy, surprisingly resilient tech sector, and then a suggestion that this is a perception of overvaluation. What does this mean? Why does it matter if fund managers think an equity market is overvalued? It means they are more prone to take profit at the first opportunity. And particularly if there is a new high reached, or there is even a suggestion of some weakness, we can expect to see that profit taking, the rebalancing, and that is then in turn is likely to enhance the volatility of that particular segment. So it does matter if equity markets are perceived as overvalued. It could ultimately be a bearish indicator when there is some weakness. On the other hand, we've seen Chinese stocks after a long languishing period when they really were showing quite a lot of inertia, and there was very little interest from the rest of the world. We've seen that now coming after the aftermath of COVID, we can see that Chinese stocks are now up 50% in the moving a year on from its stimulus announcement. So a bit of a rekindling of investor sentiment in emerging markets, and we've seen that across the board. And then we should also remember that the US stock market, being so resilient, has lifted all boats, essentially, that even markets with more fractured fundamentals, such as in Europe, have seen a strong uplift. So equity markets remain strong. It's happening across the world, even in China. We also saw some strength out of, say, South Korea. A lot of suggestion in South Korea that there is a return to more corporate governance regimes with norms, and also similar to what happened in Japan, a much more focus on shareholder protection and shareholder rights and shareholder value. So that is happening behind the scenes, not getting a lot of coverage at all in the Western press. But I did do a Bloomberg Asia piece this week, and I was particularly asked about the KOSPI, because what is the reason for this market to have turned around like that? So other markets definitely getting a look. And as we speak before about the hesitation around dollar exposure, that could well suggest that we are getting a more broad-based demand for equities, which would be a reason to diversify beyond your US equity exposure, and also in that basis to be able to rebalance into non-US. If we look to another vibe check and have another reminder that governing is hard, that it's certainly easy to run on an election campaign of fiscal prudence and cuts, that it is particularly hard to actually make them. The UK government is acutely aware of that, having had to rein in some of this expenditure cut planning. And we know in France, we're seeing riots on the streets again, as there is this pushback to efforts to rein in spending in France. So we already know that the French government collapsed, and that caused a crisis of confidence in its bonds. And we were discussing that last week. But now the government's attempt to rein in its expenditure is likely to be faced with fierce opposition, and that is that is I think something to watch there. And then when it comes to the U.S. president has been extremely busy, notwithstanding his trip to Windsor. He has not only been going to the Supreme Court with his request to fire the Fed governor, Lisa Cook, even though the lower court declared that he did not have the right to do that. She did vote on the rate cut, and she was still participating in the Fed at this time. So the president has been very busy with that. He's also been quite busy. There's been a lot of rhetoric back and forth around free speech and around some of the antagonists that may have stoked opposition to some of the commentary around Charlie Kirk's assassination. So a lot of noise circulating around that. Again, nothing with any direct bearing on markets, but certainly a distraction from maybe economic indicators when this is circulating. And we've also seen on the back of the US government taking a 10% stake in Intel, we now have Nvidia investing $5 billion in Intel. This is now being deemed President Trump's turnaround plan. So I say unprecedented. We see this also on the cards with TikTok, an unprecedented overture by the government into private companies. Not something that we see certainly in the UK or Europe, although we would have seen that for some time, perhaps in China. So I'd say that's one to watch. The fact that this turnaround plan was perceived a way to equalize a chip maker that had fallen behind its rivals, and certainly a way to posture and a form of soft power to essentially for a government to secure some of these this sway over a private company. Moving to the dollar, this has been very much in the headlines this week as the dollar continues to be weaker. It is the weakest dollar since the first rate hike in 2022. We know before that what is it weak against? It's weak against the euro. The euro is trading at a 15-year high. And the dollar being as weak as this is starting to have real ramifications for international investors, many of whom were overweight the dollar due to their overweight position in US equities. And now there's a suggestion that there is a rush for protection against swings in the dollar and a sharp increase in hedging, which could in itself then further increase the volatility of the dollar and send it down further. So I'd say that is one to watch, this flurry of hedging activity, clearly a bearish indicator for the dollar, given that non-US investors are wary, although still quite keen to hold US assets, I should say. The final slide we're going to discuss today is just some of the tail risks that came out of the fund manager survey. And I thought these were interesting because we can talk about each of these one by one and look at what they would mean for a portfolio and maybe assess our own probability that we would give to each of these tail risks. And in fact, many of them are one and the same. And the other interesting aspect of this chart is to show essentially how the probability of these tail risks has moved over time, looking just over a 3-month period. What we can see is that while let's taking the first tail risk of a second wave of inflation, and I presume this is a wave of inflation like the COVID spike. So a wave of inflation that sent in prices up to 9-10% and had a massive impact on the cost of labor, on the ability to hire, and was just really had a pinch with consumers' pocketbooks. And we know that was a real trigger of economic malaise and probably one of the key election issues in the last election. So a second wave of inflation, that is down to a probability of 26%. It was higher in August and has now subsided, probably because we've been seeing some of these indications that inflation and tariffs are not necessarily going hand in hand. And there's also been this drumbeat that there is a deflationary impulse going on, whether it's through AI, through the gig economy, through just the general power law of things costing less, that is leading to a deflationary impulse, which is what Japan faced and what we did face before the COVID spike. So that is the norm, this deflationary impulse, and the inflation then is sporadic and to counterweight to that. So that is a risk. I would suggest that the biggest risk of a second wave of inflation is political instability, because that will clearly lead the US government to wish to rectify that in some way. That is perhaps having won the election on the basis of the economy. If the economic support fades away, there will be a desire to shore that up. So there probably will be more stimulus. But certainly a second wave of inflation could cripple a consumer that is probably holding on by a thread at this point. And that would be certainly, if it were to come as a surprise, first it would get blamed squarely, probably on the Fed, but it would, having, if they hadn't anticipated that and taken some action. But it would be a surprise and would definitely be destabilizing. The second risk, which is now the dominant risk at 24%, the biggest tail risk of Fed losing independence and US dollar debasement, I'm surprised, quite frankly, to see that as high as it is. That was negligible in August and seems to have spiked in September. As I mentioned before, the definition of independence seems to be in the eye of the beholder, in that we had the Treasury Secretary suggesting that the Fed was not independent today and was essentially doing the bidding of a deep state or it had some other agenda, and that if it had been independent, it would have seen the light and would have done essentially as the President Trump's policymakers would have them do, i.e., reduce rates sooner. So I think the definition of independence is quite a variable one. And furthermore, I think we have less risk now of true lack of independence, given now how we've seen how the governors have voted, even those that have been appointed by President Trump. So that's another reason why a loss of independence may not be critical. And finally, your average retail investor is unlikely to be really moved by this, although it could affect foreign investors, and it could certainly be the tipping point for institutional participation in equity markets. So US dollar debasement, on the other hand, whereas we've been discussing this for some time and we've certainly seen the weakness, the debasement would suggest a wholesale lack of use of the dollar as a reserve currency and lack of purchasing by foreign entities. We've looked before at the actual concentration of holdings of the dollar, and they are a lot less concentrated today than they would have been before. So I'd suggest that dollar debasement is less of a concern today. A disorderly rise in bond yields, suggesting a massive increase in fixed income volatility and a crisis of confidence in the bond market. It is true that if there is any crisis of confidence, it's likely to appear in the bond market first. I suggest we've already had quite unusual levels of volatility in the fixed income market. This is still appearing on this survey as quite a high risk, as a tail risk, 22%, having come up significantly since July. This could be revisionist history at work, in that they've seen the spike in bond yields, and therefore that recency bias is leading to a belief that that is likely to be quite a disorderly tail risk. But again, I would suggest that we've already seen the worst of that already in pockets, and it would be unlikely to see where exactly we would have the potential for that to be much more disorderly. A trade war triggers global recession. This has subsided significantly to 12% tail risk. And interestingly, this has probably gone hand in hand with the suggestion that tariffs do not affect inflation. And equally, we've seen quite a lot of muddied reporting as to the actual cost of tariffs, where the revenues are going, who's actually absorbing them, who's bearing them. And there isn't really enough data at this point to attribute causation or to really give a kind of a exact work through of what the tariffs have caused. So as to this, would this cause a global recession? Again, I think some of the genie may be out of the bottle here, in that probably the worst case scenario for tariffs has already happened and has been rolled back. So in a way, we can now, at least our imaginations have been stretched sufficiently to cope with that. So I would say, whether a trade war triggers a global recession, is that a risk? Well, not as many fund managers seem to think so. And I think I would agree that that is subsiding. And certainly if you were to track the usage of the term tariff in the recent government company earnings, that is much less so. The AI equity bubble, to 11%, hovering more or less the same probability as before. I'd say that again comes and goes. We have, again, there's not any one reason for buying AI stocks. There are a complex set of reasons. Some perhaps will be illusory, some will be based on too much hope and not proven in evidence in terms of some productivity gains. But equally, other stocks, in terms of the data center demands, the demands to invest in chips, and just the massive amounts of spending, I don't think there's going to be one single incident that's going to pop that bubble. I think now AI has become so integrated in all of our lives, more so even than the internet. And I think the adoption will probably escalate as the more and more familiarity builds and as some of the prices of the models come down. So I'd say the bubble bursting could certainly cause some volatility in equity markets, but I don't see that as being a particularly large tail risk, as it is simply too endemic and too concentrated. So as I have this disclaimer up here, one last point to touch on is the suggestion that US public companies should move to a semi-annual reporting schedule instead of a quarterly reporting schedule. That has been something that experts and commentators have asked about and yearned for many years. They have bemoaned the burden, the administrative burden and distraction that quarterly earnings cause. They've also suggested that that is why that many companies are selecting to stay private, which then of course robs from the average retail investor the ability to participate in some of the most profitable companies. There are obviously transparency benefits, risk management benefits, and just a kind of a cadence of communication that investors have come to know. If they were to move to semi-annual reporting, I've likened that to a different diet, almost going to a form of intermittent fasting. Anyone who's ever tried that kind of diet will know that there is an adjustment period involved, and the intermittent fasting can make a big difference, but there can be the sense of starvation and pain and discomfort in between. So a transition like that would not be immediately good. I think it could actually throw up more uncertainty. But there is another suggestion that with AI as an ability to be a fraud checker, that this could essentially replace the need for that continuous monitoring, that there could instead be an AI form of monitoring, and that would essentially leave the companies to focus on their core businesses instead of on their reporting obligations. So just a little addendum to the discussion of the week. That is it from me. Thank you very much. I'll be back next week with a special guest, John Normand from the Australian Superannuation Fund. Thank you, everyone. Have a great week.